Hey, folks, thanks for joining me today for our opening bell for your real estate news for January 12th, 2026. I'm going to open the show by what in the heck happened last week. So, if you're a realtor, maybe you're a loan officer, if you're a homeowner, home buyer, today I'm going to explain to you guys what's going on with these. And on Friday, what happened is the Trump administration came in and they announced they're going to buy $200 billion worth of mortgage bonds in an effort to push down mortgage rates. So think of it as like QE, quantitative easing. Like, remember when rates got down to like 2%? You're thinking, okay, when are they ever going to get there again? Well, today we're going to talk about that. So, is this enough? Is the president pushing enough into bond purchases to create another QE, maybe two? That's what we're going to talk about in today's video. So, we're going to talk about that and then a whole slew of things that we're going to talk about from last week. So let's just go over what happened last week. So, we're going to first start out with the $200 billion in bond purchases. I'm going to show you how that's probably not going to really do anything. And it was a great effort, but I'm going to break that down for you. So, hard to be a spoiler alert right now. But next thing is, as a corporation, you can't buy homes. So who's that going to help? Is it actually going to help? I think that might be an okay idea for some areas. Then the Venezuela thing, I'll give you a brief thing on oil and that. And I'm not going to get political, so we won't talk about that. And then over the weekend, the president sues the Federal Reserve chairman. So how's this all going to help with rates? So if you're a homeowner, home buyer, maybe you're a realtor trying to explain to your clients, or a loan officer, which I got 100 phone calls this weekend saying, Dan, what rate can I get? Well, today we're going to explain to you guys what the heck's going to go on with those, hopefully, with today's news. So let's break it down, folks. So mortgage rates, they plummeted last week. And I'll say plummeted because they were 5.99 part of the day on Friday. Quite a bit lower than where they are right now. So here's what happened the other day. So President Trump, he comes in and he says, we're going to start buying mortgage bonds because he doesn't like what the Federal Reserve's doing. He's like, I need mortgage rates down because, I'm a real estate guy. So I need housing to really prosper during my term. And I've been telling you guys this ever since, he came in office. I'm like, he's a president that has become a billionaire on real estate. So don't bet against it. So if you like him, love him, hate him, whatever, I'm here to give you the news and nothing but the news. So here's what he did. The other day he came out and said, we're going to buy about $200 billion in mortgage bonds. So the first reaction in the markets is like, okay, this is great news. So if you're new to my channel, we follow right through here. What doesn't fit in this chart? Okay, so let me explain to you guys this chart real quick so you understand the bond market. And then I'm going to go over and let you know what he did and how low can these actually push rates. So here's the bond market. Let's go back even further. I don't want to dilute this even more. So you'll see what I'm getting at. So here's the bond market. Just think of this as a stock or whatever you want to think of. It's going along and then all of a sudden this happens. You're thinking, what happened? Okay, so here's what happened. President Trump came in and said at the end of Friday, I'm going to force the representatives that I can control, and this is Fannie Mae, Freddie Mac, that they need to start purchasing mortgage bonds. Okay, so then I researched it over the weekend, and they're going to purchase bonds, but what's called the runoff. So let me just put this in a nutshell. I'm not going to teach economics today. When the government comes in or people come in and buy these bonds, okay, what happened over the past is remember back here when rates were like crazy low? Well, this was when bond prices were way up here. Okay, so what happened is to cause prices to go up that high, the Federal Reserve was coming in every month and buying $40 billion worth of mortgage bonds. Okay, so that made the prices skyrocket. Okay, since then, here's what happened with prices. So what you have to understand is in this bond, is the price of this bond goes down, the yields go up. Well, this is a mortgage bond, so you can understand. Well, rates were at 3, and now they're at, down here, they were at 8. Okay, so now they're reprieving a little bit. So what happens with this is when people pay off their loan, here's what they've finally did. They're not going to just go out there and buy all these bonds. They're going to buy the runoff. Here's what I mean. If you refinance recently, if you haven't, check out my website. I'll give you some tools on how to do that. But if you refinanced recently, what happened is your payoff then pays off this bond. Okay, so then bonds start to mature and all this other stuff. It's bad news for bonds. What it does is it raises its basically its price. or it's yield to attract more buyers. So what the government's going to do is right now, or the yes, the government. I'm not talking the Fed. The government's going to come in and start buying all this runoff. All you need to understand is they're not going to go into the market and just buy up a whole bunch of mortgage bonds to really drive down rates. They're actually going to buy the runoff. That's a huge difference. You don't really have to understand it. Just Google how the runoff works, and I actually Google it, and there's some great news that you can grab from that. But what they're doing is they're coming in as the bonds pay off, they're going to buy those bonds back. So basically, I did this. I did some research over the weekend. I created AI and did the background for you. Here's this in a nutshell, and I'll try to post this on our website under the blogs. During quantitative easing, just to put this all in perspective for you guys, the government, they spent about $2.7 trillion in buying bonds. Okay, so they were buying mortgage bonds in the tune of about 40 billion, like I said, a month. So if you equate this out, this is probably realistically going to do not too much to rates. It might have a short-term reprieve of right through here, maybe 10 to 25 basis points. And that's what we saw the other day. So I'll get to that in a second. But one sentence explanation of this: mortgage rates are largely 10-year Treasury yields plus an MBS spread. Buying MBS can tighten that spread. The 200 billion program is typically a margin effect, not a wholesale resale. Well, basically, it's saying this isn't really going to have much effect at all when it comes to mortgage rates, maybe 10 to 25 basis points. Now, that might be enough to get you off the fence, and that was enough to get rates kind of down to 5.99 the other day. And we'll be coming out with my official forecast tomorrow. So I'm going to have a live event in the afternoon. I'll give you a precursor to that. I don't really think mortgage rates are going to change all that much. I'm still in my camp of 5.875 on the low end and 6.25 on the high end. So this is basically the news behind that bond stuff. So it's not, if you already see it right through here, let's go back to the reactions of the bond market. Again, here's the instant reaction on Friday. And when this goes up, remember, when this goes up, rates come down. So that dropped rates down into 5.99, in midday of Friday. And then here's what we had. We had reprieve down through here. And now it's giving back. We're almost back down to square one again. So we've almost given it all back. So it's great headlines. It will probably come to fruition. Is it really going to be a major change to rates? Unfortunately, no. So let's get to the next thing is now, how would this affect housing? That might be the next question you have. So if you're a homeowner, maybe you're a realtor out there, loan officer, you're thinking, okay, is this great news for the housing market? Well, let me go and say, if we can get rates in 5.99, in that basically a percentage rate psyche for a lot of home buyers and people looking and sitting on a house right now thinking, okay, should I sell it? I got a 4.5 rate. Well, if I go to 5 something, maybe the difference now isn't so bad. So here's my thoughts on what this could do to housing in 2026. Not really going to change my housing outlook, but I just want to give you some things to look at. And this, make sure you check your local areas, because a lot of people come in and say, okay, the world's crashing. And then when you really pinpoint them, like, well, Austin crashed. I'm like, well, okay, there's one pin dot in the whole country that really didn't do so well, but the overall country did okay. So make sure you're checking out your area. Let me go to 1 second over to here. If you are a homeowner right now and you're trying to figure out, does this make sense? Or, I missed it on Friday. Well, put in your information in here. Even if you put in your information in RateWatch 2, when we originally created this, as of Friday, there's a whole new system in there. Now it's AI, and I'm working the AI. So I'm trying. What happened is we had basically everybody trigger on Friday. So you might have gotten an alert. You might not have. If you didn't, I apologize. Our system just backloaded, and it's like, okay, we can't get to everybody. So we're going to be calling a ton of people today. But if you need to put your information into the new system, that this is AI, and it cycles every day and alerts me basically and alerts you guys, put your information in the RateWatch 2.0. I'm going to revise that to 2.1 because we just launched that on Friday. So let's get back to what I think is going to happen with housing. So let's go down through here. Is this a end all beat all when it comes to the affordability? No. And hopefully you watched my my 2026 housing forecast, the whole cycle was around for affordability. If you can't afford, even if rates come down, but your real estate taxes just took a 10%, 20% increase, your homeowners insurance went up 30%. So now you're thinking, okay, even rates are down from 7.5 to 6. I still can't afford that house payment because of the taxes and insurance. So those are areas that are going to get affected, and they will. But when you look at this overall, we're going to just say mortgage rates, they're probably going to be about 5.99. Okay, so if you're trying to get pre-qualified, make sure you're getting pre-qualified like 6.25, just to make sure that a payment is comfortable with you, and just for margin of error. And if you can afford that, rates should be a little bit lower than that, but think of it that way. Then let's get to inventory. And I'm going to be focusing in on this over the next couple weeks. And we focus in on it all the time because I come in and tell you, here's what housing permits are doing, here's what starts doing. And we haven't really paid attention to those when rates were 8 because nobody's buying anyways. But now what we have to look at is where's supply going us. So it's not like the builders can just go over and flip on a light switch and say, oh, okay, now housing, we got enough housing. So it's going to take a long time to do this. With rates get into the 5s, you might see builders saying, okay, this is going to help in 27, 28, and that's what they're going to go for. So there'll be more supply down the road, but it's not going to be instant. And then the demand. I'm still saying when rates hit 5.99, and I'm not going to tell you how many applications we got over the weekend. It was probably the biggest 24 hours we ever had in applications. The demand, when people see rates at 5 something, they're like, oh, that's a far cry from 7, way far cry from 8. They're at least looking at some of these numbers. Now, make sure you check out calendars we have down below. What I changed is some people were going in there saying, Dan, you're charging us for it. I'm not charging you for it. If you want to give a donation, my son created those things. Give him $1 or $2. But I created those free. You can just contribute anything you want. Again, all that revenue is going to my son. He created those. I'm not making a dime out of these folks, so help him out a little bit. Give him $1 or $2. So let's go down through here. So demand, if we can have demand, or if we can have rates in the 5.9s, 5.75, there'll be huge demand. I can guarantee you that in a lot of part of the country. Oh, now let's get to the other piece of this puzzle. Corporate buyers. Remember last week too that we had corporate buyers. I just want to go through my list. $200 billion in bonds. We kind of covered that. Can't buy a house as a company. Okay, so corporate buyers. Last week, the president came out and said, "As a corporation, you can no longer buy single-family homes." Again, it's a great, at least they're coming out with ideas. If you love him, hate him, whatever, at least they're coming out with ideas like the 50-year mortgage, make housing a little more affordable. The president doesn't control rates. He doesn't control your real estate taxes locally and doesn't control your homeowners insurance. So, these are areas where it might help out a little bit. So if you're not competing with corporations, maybe it'll do you a little bit better. So a lot of these areas, New York, Chicago, LA, just the big areas. I think Austin and some parts of Arizona, you have corporations coming in, buying in basically cities. But in most cases, like in my area and stuff like that, there's going to be no really effect with this. So now you guys hear me talk a lot of times about, supply demand. I just want to show you guys a supply demand chart, just so you get it. Okay, this is basically Econ 101. You have demand here and you have supply here. Here's where prices are right through here in quantity. All right. So I just did a fictitious thing. Let's say, for example, you're on this line and the supply doesn't move. And now you're saying rates went to 5.5. Now everybody's going to buy. What happens? Well, the demand goes up. Okay. So what's going to happen with here? Well, you got to go to the equilibrium point, and that'll move up to over here. So prices will move up. If supply skyrockets, so you have a whole bunch of new supply skyrocketing, it's going to bring down prices. So just look at this when you're thinking of supply demand. If there's more buyers and sellers, this is how basically prices work on anything. Okay, so basically just supply and demand. So I just want to throw that out there. Venezuela. I'm not going to get into political stuff. I don't really know the facts behind it. All I know is I'm looking at oil, and I'm going to pivot over to oil here in a second right through here. But last but not least, here's what we're seeing in the headlines right now. Dow Jones futures fall 300 points as Trump DOJ opens criminal investigations into federal chairman Powell. I don't know where this is going at this point, folks. So there's a lot of things the president's been doing. Some of these things I scratch my head, and then after the fact, I'm like, okay, maybe I get it. But this one, I don't know why he'd attack this gentleman basically this way. He only has a couple months left, so we'll see how this plays out. Again, this is uncertainties in the market, and the uncertainties in the market, it's usually not good. So he's going to have some backing here, but right now the Dow Jones doesn't like it. But let's get over to oil. Oil, here's we track in oil, and here's why. Think of oil. It's in everything. Everything. Okay, so as oil prices come down, you're seeing inflation, like the PCE, the inflation number that the Federal Reserve monitors right over through here. It came in at 2.8. Okay, this thing, if oil was back at $80, $90 a barrel, this would be 3 something. Okay, so oil plays a huge role in a lot of this, especially when it comes to inflation. So now let's scooch over to where the economic numbers are coming in this week, because those are what we look at. So in a nutshell, yeah, these $200 billion it's an effort. Is it really going to push down rates? Like you're seeing, I'll go to the bond market at the end of this to show you we'll probably be back at net zero by the end of the day. But let's get over to the economic calendar. So what we're going to focus in on now is what the markets focus in on and what the Fed focuses in on. And the Federal Reserve is going to meet in 16 days right through here. And I'm going to show you what they're going to do at the next meeting for sure. Okay, so let's get over to the economic calendar. Here's what we have coming in this week. Nothing today. We have a 10-year auction. We're going to see how that goes to see where that drives rates. So the last time the 10-year auction took place, that was 10-year basically bonds that the government, the deficit, they spend too much money, so to fund the government they have to sell these things. Well, last time they sold bonds, it took a yield of 4.17 to get rid of it. We'll see how that rate comes in today. Then tomorrow we're going to get some interesting numbers, and over the next few days. So let me break this down to you so you understand the data coming in the next 2 days. Tuesday, you're going to get, well, there's actually 4 numbers here when it comes to what they call the CPI. Now the CPI, think of the C in the front of that is consumer. All right, and then this is inflation. So consumer inflation. Okay, the reason why I say that is on Wednesday, you're going to get the thing called the PPI, and this is producer inflation. Okay, so the first spot that this would, the tariffs would hit, you would think would be right through here. So let's go down and let's look at what the economists are expecting, and I'll give you my 2 cents on this. So you're going to have 4 elements through here. The first one is core CPI, and then it says MOM. That means month over month. What core means, they strip out energy like oil, which would help this measure, and food. So they strip out food and energy. They're saying the last reading came in at 0.2. This reading is going to come in at 0.3. I don't know what it's going to come in at, but if this did include oil and food, I would say this is probably go down a little bit because of oil. Okay, so then we're going to go to the CPI. That includes the oil and the food and things like that. So energy and food. And again, month over month, they said previously it was 0.3 and it'll stay at 0.3. So that's, you can see where it's staying steady because mainly oil and energy is driving it down. Okay, so then you're going to get CPI year over year, and then you're going to get core CPI year over year. This is going to get the headline. So you're going to see 2.7 is the consumer inflation. So we're going to see where that comes in. I wouldn't be surprised if this came in a little bit lower, and specifically because of the oil trade, okay? And Venezuela is helping even more. And we'll get to oil in a second, see how that's faring so far today. Now, new home sales, that's going to tell us the beat on the market there, but it's really, we want to focus in on, if you're looking to buy right now, where's prices going? So these are new home sales, they're sold and they're done with, and so let's go forward. Then on Wednesday, we're going to get that PPI. This is, again, where you most likely see that inflation from the tariffs coming in. We haven't really seen it skyrocketing, so we'll pay attention to that through here. Then you're going to get existing home sales. Just make sure you understand there's new home sales. That's the ones that are being built, like from the big builders, and existing home sales. That's like if I were to sell my house. So there's a big difference between those. Okay, so make sure you pay attention to those. And then on Thursday, we're going to get the jobs report. Initial jobless claims. So look at the data that we're going to get this week. We're getting information about jobs. We're getting inflation on the consumer and the producer side. So if you go over to this section, this is what the Federal Reserve monitors. So they look at inflation, but they look at the PCE. I look at the CPI. The PCE still confuses me a little bit. I look at consumer inflation. What's my prices doing? And I'll bring you that data as it comes in. Unemployment rate, it's at 4.4. It actually dropped at the last reading. Actually, it dropped 2 ticks, and this is basically surprised the market. And the GDP behind my head, that wasn't faring too well not too long ago, and now it's up over 4%. So the GDP in the country is skyrocketing. So let's analyze this. So you analyze this for me. Please give me a comment. Make sure, can you guys hear me okay? Sometimes I listen to these after the fact, and the audio is sometimes terrible. So please let me know where you're going from here. But this is what we're seeing across the board. So here's what the Federal Reserve's going to do at the next meeting. But what would you do? Okay, so you're seeing inflation, right? Or the inflation here, it ticked up. It's still below or still above 2, where the Fed wants it. So they're thinking, okay, it's still too high. So would you be cutting rates to bring this down? Probably not. Then you go over to the unemployment rate, and it just ticked down 2 ticks. And then you're like, okay, the unemployment numbers aren't falling off a cliff. So and the GDP skyrocketing. So should we cut rates? Well, if you go to the Fed, see me FedWatch group in 16 days, they're telling us most likely there is a 95% chance Federal Reserve is not going to do anything. And here's how you read this. So across here, if you go to the CME FedWatch group, and if you're a realtor or loan officer, check these out because you have to make sure your clients understand this. So at the next meeting that's being held on January 28th, there's a 95% chance the Federal Reserve will have a federal funds rate at 3.5 to 3.75. Where is it now? Well, it's 3.5 to 3.75. So they're not going to do anything at the next meeting. They're not going to do anything at the meeting after that, and they're not going to do anything at the meeting after that. So I'm still staying with my projections of rates being at 5.875 to 6.25, folks. So that's kind of my nutshell of where we're going to go tomorrow with my mortgage forecast. So let's get back to this. Let's see if you guys have any questions. Oh, you do. It's a couple people have. Kind of sounds like status quo and not much really changing. A couple levers. You betcha. So thank you for joining me, H. Smith. But yeah, it was great reaction on Friday because we're sitting here and it's like, my goodness. So let's recap this. But if you have, let's see who else we got here. Perfect to me. So thanks for checking out my audio. So let's go back to this. Here's what I want to bring you guys back to, the bond market. So here's this. If you're new to my channel, this is what we watch. Okay, this is a mortgage bond. If you see it up the top here, let me see if I can get it down. It says MBS. That means it's a mortgage bond. How this works is this is giving us the price of a bond. Okay, if the price of the bond goes up, yields come down. Since this is a mortgage bond, the yield or the mortgage rate is coming down. Okay, so that's what we're seeing when this spiked. And then what happened is reprieve, and now everybody's saying, okay, when's it going to take place? Who's going to buy these things? When are they going to buy these things? What's going to happen? All this other uncertainties. They're like, oh my, it was great news, but when's it going to happen? And everybody just went back to square one. So we're basically back to where we were. Let's go back. If you look at a month ago, we're almost basically right there. The peak of back in December, right before Christmas, we were at 101.42. On the bond, we're 101.4, so we're up 10 basis points, which equates out to really nothing when it comes to mortgage rates. So today, mortgage rates, I wouldn't be surprised if these keep going up today and might even go back to that 6.25 rate that I thought they would get. So if you're a homeowner, what should you buy? What should you do? I'm sorry. If you're a home buyer, what should you do? Realtors, loan officers, let me get over and give you my thoughts on all this. I don't really think mortgage rates, they might click just a little bit through here. This is not going to be the end all be all with that. Home prices, it's going to be supply demand. What your areas is actually going to do. I don't think mortgage rates are going to drop down just a little bit. That might spur some buyers because I think a lot of people are just getting to the point they're like, okay, I got to move. I know I got a great rate, but I got to move. The stock market, this is going to be intriguing because like I always say, you have to be cognizant of this because a tweet and anything changes the outlook on this dramatically. So that's why I come in each day and you guys might say, okay, Dan, you changed your mind. Well, yeah, I'm changing my mind. I'm going to let you know when I change my mind because if the data changes, we have to change along with it. So here's my outlook for things. If you're looking to close, if you have a loan right now, if you have a mortgage, please use our RateWatch tool. Okay, so and if you put your information in RateWatch 2.0 when it was launched, please re-put your information in here. We'll dupe it. We'll remove all the duplicates and everything. We're even going to call some people that put in their information over the weekend because some of our data wasn't captured. So we'll be reaching out to you. But here's what my thoughts are. And then if you're above 7%, take advantage of these rates before, who knows where they're going to go from here. There's nothing really to really drop them. And if the catalyst from Friday's $200 billion thing didn't really move the markets, so you can see we're basically now down 14 ticks. So we're almost basically back to where we started the day on Friday. So the market's really not going to do anything. So if you have a rate at 7 and above, please check out the calculators down below. See if the savings is enough for you there. If you're looking to build or buy, let's say you're not closing for 2, 3, 4 months, what should you do? Subscribe over there. Just watch my videos. I usually just do a 5-8 minute video each morning, and sometimes at closing bell, and I'll give you the gist of what is going on and the whys behind it. I have no agenda behind this. I'm just giving you the truth behind this. I'm not FOMOing real estate, just telling you the truth behind all this. And the reason why I do it, folks, my name is Dan Frio. I'll explain to you what I do and how I do things. I'm actually a licensed mortgage loan officer in all 50 states as well as Puerto Rico. I created this slogan a couple of years ago when I joined the bank, and it's this. It's one application, one credit pool. We're going to compare your loan with over 30 different lenders. How do we do that? Well, let me just explain it to you real quick. I work at a bank that's blessed me with licensing all over the country, all 50 states as well as Puerto Rico, but they've been ingenious with this. They're like, okay, when people call us and they reach out to all the loan officers, what are they looking for? And we're like, products and rates. They're like, well, how can we get more products and rates? We're like, okay, get more lenders. Like, how do we do that? So we've set up ourselves with over 30 banks, credit unions, lenders. So when you call us, you put in your application with us, we're not only going to get you approved, we're going to scan, once you're approved, 30 different lenders to see if somebody else has a better rate than us, and we can use them, their services. And you'll work with yours truly during this whole process. So it's an awesome experience, and we'll take care of you. I've been doing this for over 35 years. I promise you I got your best interest in mind. Let's see if we got any more questions here. Purchased, let's see, we got. So purchased 2 years ago at 6.875. Really hoping it will, here, I can't read it from that screen, be the year that we can refinance. I watch daily, and I'm waiting for the magical 3% rate lifetime life. When does it make sense to pull the trigger and refinance? Yours is the exact question everybody's asking. They're like, okay, I'm at 6 something. I'm at 6. Most people, believe it or not, and if you join us Wednesdays, and that's where we really want you to join us. And check out my live. Alan and I did a live event the other day, and it was pretty short, but we show you how behind the screens, most people are actually getting rates in the 5s, even though it's publicized up here. This person over here it's 6.06 rate. They're buying a house, putting down 20%, things I guess. But when it comes to refinancing, especially right now, a lot of rates you can get in the 5s. So check out Jareth. Check out the calculator down below. And the biggest thing is costs. If it doesn't cost you much, now the reason why a lot of people put it off, and you might even be the same, is you looked at your closing statement when you bought, and you're like, those closing fees are crazy. I don't want to pay $10,000 in closing fees again. Well, you won't, and I wouldn't suggest you do that. When you're refinancing, most of the time what will happen is the cost will be a fraction of what they were when you bought. So an example for me, I live in Chicago. If I bought my house, I can guarantee my title fees would be at least $8,000. Refinance, they're $995. In some cases, you might need an appraisal, you might not, and that's usually $500 or $600. That's usually the majority of your costs. So check it out, see if there is some reprieve for you down there. But if you're looking to close or buy a house in the spring, or you're building, I don't think you have anything to worry about, because if you really analyze all the data that we go back to in regards to this, even the bond things, is the government's going to come in and buy these bonds. It'll basically stabilize. Maybe it'll take some of the bond vigilantes out and reprieve rates a little bit more. So can we get rates back at 5.99? Yeah. But, where are they today? 6.06. Not that huge of a difference. So check out how much your savings could be for you today. But again, if you're looking to build or buy down the pike, I don't really think you're going to have any shocks like the people did in 2020 and 2021 when they got into those contracts to find out, they thought they were going to get a 3 or 4% rate, and then it was 8, and they couldn't afford that house. So don't let that be you. So end of the day right now, we have the MBSs down 15, folks. So it's basically looking like it's giving back almost everything, and we're back to where we were last Wednesday or Thursday. So make sure you sign up for the RateWatch, new RateWatch 2.0, and I'm going to change it to 2.1. But please, even if you subscribed last time, make sure you put your data in there. This one's controlled by AI that I created. It's me, and it's pretty awesome, and I track it daily. So that's it for today, folks. I will be back at the closing bell to let you know how this day goes. But so far, the bond market's looking pretty pretty darn bad. And if we go over the stock market, it's an un-Cinderella day there. We have all the indices down. We have the 10-year yields up. And well, let's go to crypto. Crypto's up, so a little bit of a sparkler for the day. So that is it for today, folks. Mortgage rates, they will be popping a little bit today because of this news. But if you need some assistance with all this, please reach out to us. We would love to help. So thanks for watching. We did it. We went over 40,000 subscribers last week. So thanks to you guys for watching me and joining me each day. So if you still want to subscribe over there, I'd love to help you. Next tier is 100,000 by year end, and hopefully you can get me there. So thanks for watching, folks. I'll see you at the